Welcome to The Deep Dive. We're the show that digs into the details, pulling out the key insights so you get the full picture faster.
That's right. And today, we're tackling American Vanguard's Q2 2025 earnings call.
Yeah, a really interesting quarter for them. Saw some major operational shifts, some strategic wins.
Definitely. Our goal here is to, unpack what happened, but more importantly, why it matters for American Vanguard and, well, for the whole agricultural market you might be following.
Okay, let's jump right in. The numbers.
Yeah.
Because honestly, American Vanguard put up a really strong quarter, particularly when you look at profitability.
Yeah, quite impressive on that front.
So GAAP EPS loss was 3 cents. Now, context here, consensus was expecting an 11-cent loss. So that's an 8-cent beat.
A huge beat, yeah. And it's a massive improvement, like 93% less of a loss than the same time last year.
And look at adjusted EBITDA, nearly doubled. Came in at $11 million.
That's a 79% jump from the $6.2 million they did in Q2 last year. Strong growth.
And this one really grabbed me. Gross margin expanded nicely to 31%.
Right, up from 29% last year. And remember, it was only 26% back in Q1.
So highest level in 5 quarters, that's significant.
It really is. These profitability boosts, especially that gross margin jump and the EBITDA growth, well, they're not just good numbers on a page. They signal some real internal strength, effective execution. For anyone watching the stock, these are key indicators. It suggests, the company's getting a better handle on its costs, its core costs of goods sold, maybe improving pricing power too. It's not just trimming fat around the edges.
Right. It feels more fundamental.
Exactly. A potential shift in how they actually make money.
Okay, so strong on the profit side.
Yeah.
But top line revenue growth, a bit more muted, wouldn't you say?
A little. Revenue was $129.3 million.
Yeah.
The consensus was just a touch higher at $130 million.
So technically a slight miss, but still it represents 1% growth year over year, which, isn't bad.
No, it's respectable. But what really stands out alongside that is the cost discipline you mentioned.
Yeah, operating expenses as a percentage of sales dropped to 27%, down from 31% last year.
And that's driven by, a $5 million reduction in actual costs?
That's right, about $2 million from SG&A and nearly $3 million shaved off R&D and regulatory spend.
See, that OpEx control is another key signal. It shows management's really serious about efficiency, about optimization.
And you see it flowing through to the balance sheet, too.
Absolutely. Some really significant progress there. Inventory was down, get this, $53 million compared to last year.
Wow, $53 million. That's substantial.
It is. And debt, down $22 million, sitting at $189 million now.
These aren't small tweaks. They feel like material improvements in, cash flow, financial stability overall.
Which is crucial, right? Especially given the market conditions aren't exactly straightforward right now.
Okay, so profitability, cost control, looking good. How are they actually doing it? Management was pretty direct. They said they're in the midst of a business transformation.
And that these efforts are beginning to bear fruit, though they did add the caveat that it's still early stage.
Right. The long-term target is still that 15% EBITDA margin. So if it's early stages, what should we be watching beyond just this quarter's results to see if this transformation is, sticking?
That's the million-dollar question, isn't it? Sustainability hinges on making this operational rigor stick. And one of the biggest changes they talked about was setting up a formal procurement organization.
Which they didn't have before. Seems surprising.
It is, yeah, for a company this size. They brought in a new team, Jared Strelly leading operations there, and management's quote was pretty telling. Procurement people pay for themselves almost instantaneously. They even added more resources in Q2 just to get longer lead times for planning. This isn't just a minor adjustment, it's fundamental.
So it's not just about haggling for better prices.
Not at all. It's strategic sourcing, managing the supplier relationships, quality control, forecasting needs to avoid disruptions. Before, they might have been more reactive. Now, it sounds like they're trying to proactively shape their cost structure. That cuts risk, improves availability long term.
Makes sense. And it wasn't just procurement, right? They also mentioned improvements in their SIOP process, sales, inventory, and operations planning.
Yes, exactly. They highlighted that as key for better manufacturing performance and those margin gains we saw.
For folks maybe not familiar, SIOP is basically how you line up your sales forecasts with what you actually plan to make and hold in inventory.
Right. And they admitted their factories were underutilized before. So now they're working on efficiencies, aligning production better, using that SIOP process, even looking at third-party toll manufacturing.
So making the assets they have work harder, smarter. optimizing the whole chain from forecast to finished product.
Precisely. And the goal ties back to that OPEX number, pushing it down as a percentage of sales into the low 20s.
Low 20s, that's ambitious.
It is. It tells you they're scrutinizing everything. The mantra seems to be simplify, prioritize, deliver. And that discipline, well, it leads directly to a healthier balance sheet.
Yeah, let's talk more about that balance sheet health because it's really showing up. That improved SIOP process, the discipline, inventory only grew 7% in the first half of this year.
Which sounds like a lot until you compare it.
Exactly, compared to 12% growth in the first half of 2024 and a huge 29% jump in 2023.
And year over year, as we said, inventory is actually down $53 million.
They're even talking about getting their inventory turn ratio closer to 2 by late 26, maybe early 27.
Which is all about efficient capital, less cash tied up in warehouses, right?
Right, frees up cash.
And that cash, along with operational cash flow, feeds directly into cutting debt, down $22 million year over year, as we noted.
And they expect strong free cash flow this year.
Yeah, CapEx is estimated super low, like $5-6 million, against that projected adjusted EBITDA of $44 million. So big gap there.
And the plan is to use most of that free cash flow to pay down more debt.
That's the stated intention. And connecting the dots, remember they extended their main credit facility with BMO after the quarter ended, pushed the maturity out to the end of 2026. Ah, okay. So that takes near-term refinancing worries off the table.
Exactly. Gives them breathing room, critical runway to keep executing this transformation without, excessive financial pressure.
Okay, let's switch gears slightly. Their green solutions business. What's the story there? It sounded like there was some softness in the U.S.
Yeah, apparently due to some tariff uncertainty. Green Solutions, just for clarity, that's their portfolio of biologically derived products, more sustainable ag options, increasingly important segment.
Okay, so tariffs impacting the U.S. side.
Seems so, but globally it's still growing faster than the rest of the company. And management expects double-digit growth for Green Solutions for the full year 2025.
And they expect a pickup internationally later in the year.
Yeah, Central and South America sales are expected to materially pick up in the second half.
Yeah.
That's typical seasonality for them down there. The U.S. tariff issue probably messes with pricing or import dynamics for those specific products, maybe less so in other regions with different rules. Gotcha. Okay, despite little pockets of softness like that, management sounded, well, pretty confident overall.
Very confident. They reiterated the full year 2025 guidance, revenue $535 to $545 million, and that adjusted EBITDA range of $40 to $44 million.
And expressed strong confidence in hitting those numbers, which is notable considering the broader ag economy isn't exactly firing on all cylinders.
No, it isn't. And management acknowledged that. They actually said the ag cycle seems to be at or near the bottom.
At or near the bottom.
Yeah.
That implies, what, stabilization?
Yeah, stabilization, maybe early signs of recovery in things like commodity prices, farmer income, spending on inputs, all crucial for Morgan Vanguard's customers. They also think the worst of the ag-chem destocking is mostly done.
Ah, the great destocking wave. So that was only a slight headwind in Q2, they said.
Apparently, yeah. Seems like distributors are finally working through that excess inventory buildup from prior periods.
And there's some policy tailwind, too, potentially, that new Farm Bill legislation.
Right, the budget bill aspects. Supposed to provide something like $66 billion in subsidies over 10 years. And critically, improving reference prices for crop insurance.
Which directly helps U.S. farmers, gives their core customer base a bit more stability.
Definitely provides a better backdrop for American Vanguard going forward, though it's not uniform strength across the board.
No. What areas were strong or weak?
They mentioned strength from increased corn acreage, and that slowing destocking helped granular soil insecticides. But the cotton business, for example, was weaker, so still a mixed bag within agriculture.
Okay, let's pull this all together. What's the market telling us here? The stock popped, 9% or so after the call, despite that tiny revenue miss.
Yeah, that reaction suggests investors are looking past the top line for now. They're prioritizing the big improvements in operations, the margin expansion, the balance sheet cleanup.
So the sentiment shifted from just cautious to maybe?
Yeah.
Cautiously optimistic. Constructive.
I think constructive is a good word. It signals a belief that this transformation isn't just smoke and mirrors, that it's real.
The narrative is changing.
Exactly. It's moving away from just stabilization toward maybe a measured expansion story. One built on these efficiency gains sticking around. It's not about chasing crazy growth. It's about discipline, structural improvement. Investors seem to be valuing that durability.
And there was that interesting comment about their U.S. manufacturing footprint being a potential opportunity.
Yeah, that was intriguing. How that might play out with ongoing tariff discussions.
How so? What's the potential advantage?
Well, it's kind of a wild yet plausible scenario, right? If tariffs make imported chemicals more expensive or harder to get, suddenly having a significant manufacturing base in the U.S. could become a real advantage.
Driving demand domestically.
Could happen. They said it's not in their base forecast, but it's out there as a possibility. Could provide some unexpected upside if global supply chains get rerouted due to tariffs.
And they also mentioned being well suited for the current ordering patterns, this sort of hand-to-mouth flow.
Right. The industry trend towards smaller, more frequent just-in-time orders. They said their operations and customer service can handle that kind of in-season demand well. It aligns with how they've often operated. So that flexibility plus the potential domestic demand shift, yeah, it positions them interestingly.
Okay, so if you're tracking American Vanguard, what are the key things to watch going forward?
Well, first, definitely keep an eye on those gross margins and the adjusted EBITDA run rate. Are they staying on track for that full year guidance?
Makes sense.
Second, that seasonal pickup for green solutions in Latin America in the second half doesn't materialize as expected.
Okay.
Third, any more moves from management on, say, footprint optimization or further cost actions, always worth watching.
And fourth.
The macro picture, of course. Trends in crop prices, farm spending, signals about that agricultural cycle recovery. Is it truly bottoming and starting to turn?
Right, because the big question for the longer term is, can they keep these margin gains going as the cycle recovers? Maybe even accelerate them.
Exactly. If they can do that, it really changes the story from stabilization to potentially sustained expansion, giving them real leverage into a recovering market.
Okay, that sets things up nicely. Which brings us inevitably to our not financial advice segment. How could you potentially structure a trade around this?
All right, let's brainstorm. This isn't about some revolutionary new product. It's more of a deep value turnaround play, right? Execution meeting the macro cycle.
Okay, so what's the structure?
How about this? A straightforward, long position in American Vanguard stock, AVD, maybe combined with selling a put spread underneath it.
Interesting. Long stock, short put spread.
Yeah.
Walk us through the thinking there.
Okay, the core idea, the internal story, the market still seems to be underappreciating just how much impact these operational changes are having. Gross margins at a 5-quarter high, EBITDA nearly doubling. This feels structural, like you said. The procurement changes, the SIOP discipline, it's real.
Plus, management's confidence, the debt pay down, the extended credit line. That forms a pretty solid base.
Exactly. A rock-solid foundation. Now, layer on top of that the wild yet plausible element, our sort of hidden alpha, the tariff turbocharge.
Ah, yes, the U.S. manufacturing angle.
Right. Management hinted at it. If tariffs disrupt competitors relying on imports, AVD's domestic production could see a surge in demand. That's a massive potential tailwind that doesn't feel priced in at all. It's like a potential tariff moat protecting their U.S. business.
Okay, so internal transformation plus that external tariff catalyst.
And don't forget the third piece, the inventory inflection.
Yeah.
Destocking is easing, the ag cycle is bottoming. It's not just internal efficiency or external demand picking up, it's potentially both aligning at the same time, synchronization.
Right, so why the short put spread specifically? Why not just long stock?
Well, the short put spread hedges things a bit. You sell a put, collect premium, and buy a cheaper, lower strike put for protection. It gives you some cushion if there's a minor unexpected dip, maybe in the ag cycle recovery, while still letting you participate in the upside.
So you collect income while waiting for the thesis to play out.
Basically, yeah. The bet is that the combination of the operational discipline, that tariff kicker, and the cycle turning will drive the stock higher, making those short puts expire worthless. You capture the premium plus the stock appreciation.
So it's not just a simple turnaround bet. It's positioned for resilience against tariffs, focused on margin expansion, kind of a multifaceted play.
You could call it a strategically positioned, tariff-resilient, margin-expanding juggernaut. Maybe that's too strong, but you get the idea. It's playing multiple angles.
Got it. Okay, let's wrap this up. To recap, American Vanguard's Q2 showed real teeth in its business transformation efforts. Big improvements in profit, margins, balance sheet health.
Yep. And while revenue was just okay, investors clearly liked the operational story.
Looking ahead, destocking seems to be fading. There are hints of the ag cycle recovering, and they have this potential strategic edge with their U.S. manufacturing in a tariff-heavy world. It seems like they're pretty well set up for more progress.
Appears so. Lots of moving parts, but the execution in Q2 was definitely encouraging.
Okay, now the important bit, remember everyone, this deep dive is for information only, definitely not financial advice. Please, always do your own research, your own due diligence.
Absolutely.
So thinking about this American Vanguard story, what does it tell you about the power of just grinding out operational improvements, even in industries that seem pretty mature? Something to chew on. Thanks for tuning in to The Deep Dive.